Okay, let's focus now on tech stocks. Nvidia shares are slightly down in the pre-market, but of course investors all over the world are preparing for the earnings report from that company tomorrow. Meanwhile, China making rapid progress on artificial intelligence. Our guest says investors should remember it's hard to keep growth stocks down. We're joined by Philip Petursson, Chief Investment Strategist at IG Wealth Management. It's great to see you, Philip. Thanks very much indeed for joining us. So investors got a fright when it turned out China is an emerging power in artificial intelligence. Is this a threat to the big American AI-related stocks?
It depends on how they respond to it. You know, we discuss one of the greatest or the worst things the United States could do is restrict chip sales to China. That just forces them to become more innovative, and forces new technological advances out of that innovation. And so now it's gone the other way. It's going to force the American companies to innovate as well to try and keep up with the developments that are going on in China. So all this we think is good. It's a good thing. It's not necessarily bad, provided the companies continue to do the right thing and keep moving forward.
There's a school of thought that maybe the time to play AI with the chip stocks may have passed, and it's now time to focus on companies that will make loads of money implementing AI.
Exactly. It's who can monetize it best. And so here we look at companies like Salesforce, right? And notice what happened when DeepSeek came out. You know, the stocks that
see around the symbol. Carry on, please.
Exactly. Yeah, and those stocks that went up were those the utilizers of AI technology, not necessarily the developers of it. So Salesforce was up, Workday was up. These companies stand to benefit from the utilization of AI that they can then monetize through their own subscriber base.
And of course, Meta has been on fire this year.
Exactly, and the same thing. It's you know, Meta can all these companies can back away from making heavy investments in AI development themselves and utilize technology that is being developed elsewhere in the world.
Broadly speaking, you think growth stocks have the wind at their backs right now?
Yes, when we look economically, despite the tariffs, and we put the tariffs aside because we don't even know what actually is going to come out of them. But when you look at the U.S. economy, the Canadian economy, and other economies around the world, they're stable, they're growing. Or we see less risk of recession in 2025 and as we head into 2026, and more sustainable growth. All of our indicators that we follow are trending upwards, not downwards, and that's good. And so that means that companies should benefit through greater earnings growth in 2025 to the mid-teens. I mean, that's what we're seeing in the United States and Canada, and that sets up for attractive markets. Perhaps not the same extent that we saw last year, but still good markets nonetheless. And
retail money has been coming into the U.S. market consistently?
Well, it has, but I think it's starting to flow to other areas, to cheaper areas around the world. Canada has done a little bit better than the U.S. year to date. International, Europe in particular, has done better than the U.S. And I think that comes down to the valuation. So while we like growth, you don't also want to overpay for stocks. And so U.S. stocks are at the peak or the top of what we would say is the fair value range, whereas Canada is in the mid-range and Europe is at the low end. And growth should be somewhat synonymous around the world. And so cheaper areas to capture that growth can see stronger returns.
Bank of America says when it talks to international investors, they are not keen on the Canadian banks, relatively speaking. And I'm assuming the tariff threat's part of that. I mean, this country is vulnerable.
Potentially. I don't see it playing through to the banks themselves. I actually see the financials somewhat immune to the tariffs. If you think about what the expectations are for 2025, higher M&A activity, higher IPO activity, this should be good for the banks. And strong capital markets over the past couple of years, combined with a steeper yield curve, should lead the banks to higher profitability in 2025, not lower, with the valuations of the banks as well. When you look across, whether it's the TSX or the S&P 500, you look, the cheaper sectors are financials and then energy. So I actually see positive, or I have a more positive outlook for the banks going forward.
It's interesting. Maybe we could put up a 5-year chart for the banks index. It outperformed over the past 5 years. It outperformed into early 2022, then came down. But over 5 years, the total return from the banks index, about 72%, matching the TSX 71%.
Exactly. And we have to remember, when you're talking about the TSX, you're really only talking about a couple sectors. The banks, so what's your outlook for the banks? It's somewhat positive. Energy, what's the outlook for energy? It's somewhat positive. And the metals and mining, same thing. So the drivers of the TSX are in positions to benefit from the broader economic environment in Canada and globally this year.
Just for fun, on my Bloomberg screen, I'm looking at the 20-year relative return on the banks. And my screen here is showing a total 20-year return from the Canadian banks north of 600%, whereas the TSX return only 360%. So they sure have delivered in the past.
They have. They're solid blue chip companies with great dividend policies, great management that I think is set up to continue.
Do you have particular thoughts on BMO? There have been misgivings over their U.S. operations, but the company overall, its earnings beat in the latest quarter.
Yeah, we don't necessarily drill down. My team doesn't drill down to the individual banks themselves. But when I was taking a look at the chart, technically that chart looks attractive. It looks like BMO's more on the upswing than the downswing. You compare that to the chart on Scotia, which it looks like it might be in a bit of a downward trend right now. Out of the two, I would say BMO looks more attractive.
That's interesting, yeah. Scott Thompson, of course, the CEO, eager to prove himself. But there is still uncertainty over because that stock underperformed for years.
It has, and there is a catch-up that needs to happen, and I think it has to come from perhaps better direction out of the company, and that's what's being reflected in the stock right now.
It's interesting, though, what you said, though, near the top of the interview about growth stocks. I mean, there's animal spirits out there just betting on decent economic times ahead and profit growth.
Yeah, exactly. When we look at the U.S., I mean, the U.S. is set to grow this year at 2.5%. And that actually is decent growth. It's not stellar growth. You know, I don't want to call it Goldilocks. I'm not a fan of that phrase. But provided this administration doesn't do anything to muck up the gears of the U.S. economy, we should see decent growth, and that should be followed with strong earnings growth.
Great talking to you. Thanks very much.
Thank you.
Our guest has been